Okay, I do want to start here, actually. Yeah, hi. How's everybody doing today? Good, good. So this is interactive, and I'll be asking you guys questions too, so we'll have some fun. So just to kind of go over what she was talking about, so yes, we'll be talking about Prop 60 and 90, and also we're going to be talking about Section 121. I actually want to talk a little bit about that now because we don't have it on any of our slides. So Section 121 is the IRS code section that says that if you sell a property that's been your primary residence for 2 out of the last 5 years, of any time within that 5-year period, if it's been your residence for 2 of those years, primary residence, then you potentially qualify for a $250,000 capital gain exclusion. Or if you're married, it's $500,000 capital gain exclusion. It's actually $250,000 each, so if both of you qualify, then you each get the $250,000. So I'll give you a couple of scenarios. So I love stories, okay, because it kind of brings to light what people think about. So I had a call from a client, and it was like May, and she says, I'm really excited. I'm getting married. I go, that's great. You're getting married. So she was in her late 40s, early 50s, so I was really excited about her getting married. And she says, I'm also going to be selling my property. I go, well, that's super too. So I said, well, tell me the timing of all this. And she said, well, okay, so we're selling, this person, I guess, had lived with her for a couple of years, okay? And to go back to the rules, besides the 2 out of 5 years, there's 2 other rules. The first one is that both of you, each individual, has to have the principal residence for 2 out of 5 years. But if you're married, only one of the 2 has to be on title for 2 out of 5 years. So if somebody's living with somebody else and all of a sudden they get married and the property's been in the title of one person, that other person automatically qualifies if they live 2 out of 5 years. So in this particular scenario, she was telling me, well, I'm going to put my house on the market next month. I said, well, that's great. I knew where she was going, but I wanted to just ask her the questions. And so I said, and when are you getting married? She said, I'm getting married in November. We're planning this huge thing. I said, well, you realize that he does not qualify for the $250,000 exclusion. She goes, why not? I said, because at the time escrow closes, he's not married. You're not married. She goes, well, who's to know? I go, that's not the question. Question is, I'm signing your return. I'm telling you right now, if you sell the property and he's off title, not he's off title, but he's not married to you at the time, he does not get his $250,000. Okay, yes?
Couldn't they just go to City Hall, get married that day, and then?
That's what I told her.
Later?
That's what I told her. I said, listen, go to City Hall, get the marriage. Don't tell anybody. Yeah. Go through your huge wedding 5-6 months from now, and guess what? That saves you, let's say capital gain rates right now at 33%. That's an $82,000 thing just to go get your marriage license. Okay. So there's a little bit more to 121, and you get other situations too. You have a brother and sister living in the house. They're not married, obviously, but if they both qualify, they both get the $250,000 exclusion. So there's a lot of situations where this works. Okay, now we'll get into the seminar. If I can get this right. Prop 60, Prop 90. Okay. Oh, I went too fast. Okay, oh, that's right, Prop 60. Okay, so Prop 60 was obviously because of the numbers, Prop 60 came first, probably several elections in between. And so basically it says this. If you sell your property and you purchase another property, principal residence again, in the same county, right? And you pay less for the property that you're buying, let's call that the target property, then you're selling your property for. And if you're constructing a property instead, so in other words, you're selling a property, and in that same county you bought a piece of land, and now you're building your property. You have to so you got 2 years in order to complete that house and have it livable in order for it to qualify as your principal residence. Okay. And then the last one is you only get one per lifetime. And we'll come back to the one per lifetime because there are a lot of quirky things with regard to that. So that was the original Prop 60, okay? So then we got the Prop 90. And Prop 90 says all of the former still applies, but, and back then, all the counties were cooperating. So it basically said, if you sell your primary residence and you purchase a property in a cooperating county, okay, then you will be able to transfer your property tax base to that new house that you buy in the new county. Obviously, the same rules apply. If you buy it for less, and we'll get into some scenarios where you can actually buy it for more in a little bit, but if you buy it for less, and if it's constructed in another county, it used to be, people are selling property in San Mateo County, and they're going up to Auburn, and they're building a brand new house. Okay, used to be able to do that, not anymore. Why? Because that county does not cooperate. Okay, and so that's the biggest thing. So the receiving county has to cooperate. Now, who are the counties we're talking about? So up here, we're talking about Alameda, San Mateo, and Santa Clara. Then you have Tuolumne County, which is the rose among thorns, because you could still buy property up there that you can live in the country, right? And still do your little purchase and roll your property tax base from here over to there. And then you got some down south. You've got Riverside, you've got Orange, and San Diego. Okay, so yes.
Quick question. In the earlier slide, you said the new property has to purchase for equal or lesser than
Correct.
previous property.
Right, but
Equal or lesser than what on the previous property?
then you sold the previous property for.
Okay, the actual sale, so current market
Yeah.
value.
Yeah, so if you sell your property for $1 million, you can't go out and buy something more expensive. There are.
You can't put more money in and get the low basis, I got it.
Yeah, but we're getting into some quirks about that, okay? So this is where the audience participation comes in. So if I sell my property in San Francisco and buy another property in San Francisco, am I okay?
Yes.
Yes, yes you are, because you're not going to another county, you're staying in San Francisco. Now, if I sell my property in San Mateo and I go to San Francisco, am I okay? No. If I sell my property in San Francisco and go to Santa Clara, am I okay? Yes. Yeah. So it has nothing to do with the fact that San Francisco is a very uncooperative county. It has more to do with the fact that Santa Clara is a very cooperative county when it comes to this. That make sense? All right, good. All right, okay, so now we're going to get into 4 scenarios, and these are the fine points about what we were talking about, lesser than or equal to and all that. So scenario 1 is you sell your property. Scenario 1 is you buy your target property before you sell your property, okay? So in this particular case, let me see here eventually. Yeah, so in this particular case, you have to make sure that if your target property sells for $1 million, that you're not selling your property for more than $1 million. Because if you do, then it doesn't qualify. I'm not saying to sell your property for less on purpose, but you have that kind of quirky thing to where if you buy your target property first, that's the limit of what you could sell your property and still have it work. Okay, does that make sense? That's if you buy your target property first. Okay. Okay, so you can also rent your property out. Okay, that's the example here. So you move out of your house. Ron's going to talk about that a little bit later when it comes to the exchanges and other things. But you can rent your property out first before you sell it. So, and that's what happens. You buy your target property, you rent your property out, and then a year or 2 later you sell it, and hopefully that property, hopefully it sells for as much as it can. But if it sells for more than you bought your target property for, if it sells for less than what you bought your target property for, then you have a problem. Okay. All right. All right. That's.
I have a question.
Yeah.
The property that you purchase to identify as the property that you're going to make the, for your property tax? Do you have to move into it, can it be rented for a little while and then you move into it?
Okay, so you're saying that your target property is going to be a rental first?
Yeah.
I have to think about that. I know one thing that the county looks for with regard to that kind of situation, and any situation really, is the homeowner's exemption. So I would really, I'd have to think a little bit more about that, but I think the homeowner's exemption has a lot to do with it. So if you rent, so basically you're renting a property out and then you're moving into it, but you're still living in your own property, correct? I'm going to say you're probably okay, but I'm going to think about that. Okay? Yeah. All right. So scenario 2, this is where you purchase your target property, okay, residence within 1 year of selling your old home. If you do, then you're able to add 5% to the sale price of your old home in buying your new one. So let's, in an example here, we've got, you sell your old house for $1 million, okay? And so you sell your old house first. If you buy your new one within that first year, you're able to add $50,000, 5% of the million. So now you could buy a replacement property for $1,050,000 and still carry over your property tax base, okay? Scenario 3, guess I'm doing this right. Okay, scenario 3 says you sell your old property and then a year plus, but within 2 years later, you buy your target property. So you sell your property on January 1st of 2018. On January 2nd of 2019, you buy your target property, your new property. So it's been 1 year plus a day. Now you're able to add another 5% to the purchase price of that target property and still be within the Prop 60, Prop 90 rules. So in this particular case, you sell your house for $1 million, you're able to buy a house for $1,100,000 or no more than that, you know, and still be within that percentage basis and be able to carry over. Again, this is all has to do with carrying over your property tax base on your old home to your new home. Okay. Understand? We're good? Okay. Scenario number 4. So you sell your property, and then you rent out for a while, you do some traveling, and then 2 years passes, and then you say, oh my gosh, we got to live somewhere. So you go buy your property, you go buy your replacement property, say 2 years and 2 months later. And then you go back and you try to use Prop 60, Prop 90 to get your property tax base from your original home. This 4th scenario says you cannot do that. You have to purchase your target property within a 2-year period in order to, and that's 2 years either way, right? Because if you bought your target property 2 years before selling yours, or within 2 years of selling your property, one way or the other, so you have a 4-year span kind of, that's the only target time where you'll have a chance to reduce your assessed basis on your new property by using your old basis of your home for property tax purposes. Okay, additional notes. Okay, Prop 60 and Prop 90 are completely elective. You don't have to use it, okay? So you say, well, what kind of scenario would you have where you wouldn't want to use it, okay? So let's just say that you have a couple of homes. You have a vacation home up in the mountains somewhere, and you have your principal residence. So you sell your principal residence, and you bought your principal residence 5 years ago. So your property tax base is huge, okay? So you sell your principal residence, and then you decide, we're not going to use the Prop 60, Prop 90 rules. We're going to move into our vacation home and make it a principal residence, a permanent residence. We're not going to rent it out. And say 3 years later, you decide you want to sell it. So you meet the 2 out of 5 year rule. And also, you meet the Prop 60, Prop 90 rule as long as you buy another, depending on the county, cooperating and all that. So if you have really low basis property that you're dealing with, it might be more advantageous to use that property tax base on your eventual target property. So not many situations where that works, but that might be one of them. Okay, all right, additional notes. Okay. All right, so if we talked about a scenario before where you bought a piece of property, a piece of land, and you built, okay? So you have to remember that when you go and do the construction and you're finished and you're trying to figure out what the cost basis of that, the purchase price, so to speak, of that new property is, the newly constructed property, you have to include the land cost in that whole property. That, it's that way you really have less of a chance of making depending on when you do the construction and how much you sold your property for. So, but you have to include the land. All right. Okay. The other thing too is within 3 years of selling your property, you have to actually go ahead and file for the claim to the county that you're in order to have the property tax exemption. It's not property tax, but the Prop 90, Prop 60, Prop 90 rules apply. So it's not, as we found out in the last slide, it's not elective. It is elective, it's not mandatory. So you have to go and file your claim with the county within the 3-year period, or else you will not be able to do so, ever, okay? Okay, additional notes. Okay, 55 or older, all right. So this is kind of there are some quirks here too. So like you said in one of the first slides, it's only once in a lifetime that you can use this particular gift, let's say, and you have to be 55 or older. So you have a lot of different scenarios. So I had one where the gal, this is like 15 years ago because he was 70, he's 70 now, but back then he was like 56, so they used the property tax rules of 60 and 90 to roll over their old property tax base to their new house. She happened to be 53 at the time, he was like 56. All right, so he has since passed away, and she sold that house and has bought a new house. And so she was trying to roll that really old property tax base into the new house. So she called up to Sacramento, she went up and saw them because the county was giving her a bad time. And the reason they were giving her a bad time is because when her husband at the time, who qualified because he was 56, filed for the exemption because he was married with her, her exemption was also used up. So as a couple, you only get one. So then you have a situation where, okay, let's take my friend who, say she wasn't 49, say she was in her 60s, the one that got married and was going to have the husband. So they might have a situation where they're going to buy a house, and let's say the husband has previously used his exemption, the Prop 60, Prop 90. They might consider her buying the house, getting the exemption, and then marrying. That way, she can use it without being tainted by his use of an exemption years and years ago. So there's little quirky things that you could do. Okay. All right, let me see, yep. All right, I'm going to introduce Ron Ricard, and he is going to talk to you about 1031 exchanges. Thank you, and we'll take questions at the end.
Thank you, Joe. How's everyone doing tonight? Hopefully you got some good food. They don't want leftovers, so please get more on the way out. Anyway, my name is Ron Ricard. I work for Investment Property Exchange, or IPX 1031. We are what is referred to as a qualified intermediary. Sometimes we're called an accommodator or a facilitator. Sometimes our clients give us other names that I can't use in public. But our job is to help you do what are called 1031 exchanges. Now, how many people in this room own investment real estate? About half of you, okay. And even for those of you that don't, listen anyway. Because we're going to be talking about how even if you don't currently own investment real estate, what we're going to talk about within exchanges is still going to be relevant, still could be very relevant to you. All right, so I personally have been doing this since 2002, so almost 18 years. I've been involved, actually the number is now more than 15,000 exchanges. Been doing it a very long time. Anyway, what's 1031? 1031 refers to a section of the tax code. It's a section of the tax code that says, in essence, when you own real property that you use in your business or as an investment, you can sell that property, buy replacement investment real estate, and as long as you follow the rules, you get to defer paying taxes on the profit that you've made. So what does that mean in English? You have a rental house. You have a rental house here in San Mateo. You've rented it for the last 20 years. You want to sell that and buy a duplex. So you go through the regular listing process. You go through escrow. At the close of escrow, the money from the sale comes to us as the intermediary. You then go find that duplex that you want to go buy. We put the money into escrow and the property closes. In the eyes of the IRS, you sold a piece of investment real estate and you bought a piece of investment real estate. And because you never touched the money, because we had it, you get to defer paying taxes on the profit that you've made. One thing I should note here, the word is defer, not eliminate. Okay? So you sell the house to buy a duplex, later you sell the duplex to buy a fourplex, now you're old and tired and cranky and say, the hell with it, I'm selling the fourplex. When you do, you pay taxes from the house, the duplex, and the fourplex. You are just deferring the taxes, not eliminating the taxes. So a couple of things here. Sometimes people will ask, well, why bother? Why bother doing an exchange? I have a question for you. Do you prefer to pay your taxes today or tomorrow? Tomorrow is the right answer. Even Joe will tell you that, right? We'll get there next, okay? And the way I look at it is this. If I make $300,000 of profit on something, and I have to pay $100,000 to the government, I only got $200,000 to reinvest. But because you get to do the exchange, you get to reinvest all $300,000. And that extra $100,000 that you're not giving the government yet, you get to use that to buy more real estate. But the real answer is, when do you really want to pay your taxes? Never is the right answer. And guess what? You don't have to. Because what happens to all of us eventually? We're going to die. And when you die, you win. Okay, be honest. When you die, your kids win. Because when you die, your heirs get what's called the step up in tax basis. Make sure we're on the same page here. I bought a property years ago for $100,000. Today it's worth $1 million. If I sell it, I have to pay tax on $900,000. But the day I die, whoever inherits the property from me, their basis on the property is the value of the property at my time of death. And if your kids are like mine, the day after my funeral, they're selling everything. And when they sell it for $1 million, how much capital gain do they have to pay? Zero. It's worth $1 million when I die. That becomes their basis. By the way, if you own the property if you own your property in a properly constructed trust or as community property, the death of one spouse gives a surviving spouse that step up in basis. So when you look at it, when you buy a new property, look at each other, flip a coin, see who gets to go first. So ideally, you never have to do the exchange. Our motto in our industry is swap till you drop. All right. So first off, why do people do 1031 exchanges? To defer taxes is the wrong answer. The reason people you do exchanges is because you want to buy something better. Now, what's better mean? Better means whatever the heck you want it to mean. Could be a better cash flow. Could be a better location. Could be consolidating your assets. Could be selling 5 houses to buy an apartment building. Could be selling an apartment building to buy 5 houses. Is whatever you think you want to do with real estate. 1031 is the tool that allows you to get from what you own today to what you want to own tomorrow. And that's how to think about it. Don't think about it as a way to defer taxes. Think of it as a way to get to the property you want to do it. And because we have this, you don't have to pay the tax man every single time. All right. First off, there's a term that you're going to hear a lot from people, especially CPAs and attorneys, and that term is Likekind. That term is meaningless. Because one thing to remember is that you can buy and sell any kind of investment real estate. Okay, you can sell a rental house and buy a shopping center. You can sell a farm and buy a fourplex. You can sell an apartment building and buy bare land. any kind of investment real estate can be exchanged for any other kind. The reason you hear the term like kind is because up until recently, we used to do exchanges on personal property. I personally have done exchanges on airplanes, hotel equipment, Budweiser distribution routes, cows. I've done exchanges on all of those. When you sell a cow, you had to buy another cow. When you sold a boat, you had to go buy another boat. That's what like kind referred to. At the end of 2017, Congress eliminated 1031 exchanges completely for everything except real estate. So now the whole term about like kind really doesn't mean much. The main thing to realize is you can buy and sell any kind of investment real estate for any other kind of investment real estate anywhere in the country. So you can buy and sell in California, buy in Florida, buy in Hawaii. As long as it's within the United States, you're good to go. Yes?
Can you exchange from an investment property into like a REIT?
No, a REIT, well, let's go back. A REIT is not considered to be investment real estate because a REIT is considered to be an investment in a company that buys and sells real estate. You do not have direct ownership of the real estate. Now, there are a couple of things that if you want afterwards we can chat about, that like fractional ownership of commercial real estate known as DSTs, that does qualify. Also, there is something called an UP-REIT, which is a REIT specifically designed to qualify. That's a very, very precise thing. So there are some ways that you may be able to do it, but a REIT in and of itself does not qualify for 1031. All right, so what does not qualify? Obviously, your primary residence. As Joe talked about earlier, your primary residence is covered under Section 121 of the tax code. Second homes. Second homes also are not considered to be investment real estate. We will get a little bit more into second homes in a little bit. By the way, some of you are saying to yourself, who has a second home? The answer is a lot of you. You know why? Because you're letting your kids live there and you're not charging them rent. Or your mother-in-law lives there, right? It's never your mother, it's always your mother-in-law that lives there. If you got a property and you're letting a family member live in there and they're not paying market rate rent, it is not considered to be investment real estate. And when you finally kick the kid out and you sell the house, it's not a primary residence, so you don't get your $500,000. It's not an investment property, so you can't do an exchange, so you got to pay tax on all of the gain. So this is why when you go home, you're going to call your kid, you are now paying rent. Okay? And Joe on your tax return is going to start showing it as a rental property. Another thing, flips. Flipping real estate is not considered to be investment real estate. When you buy a property, fix it up and sell it, the IRS calls that a job. Okay? I always liken it to going to Safeway. When you go to Safeway to buy a can of soup, is that soup an investment? No, it's inventory. They bought it from Campbell's and they're selling it to you at a profit, right? They buy a chicken, they cut the head off, they wrap it in plastic, and they sell it to you. That's a fixer-upper. They bought it, they fixed it up, and they sold it to you. That's exactly what you're doing with real estate. Same thing with development. You buy a beat-up old house in old San Mateo, you bulldoze it, build yourself a brand new McMansion, and sell it. You're a developer. That's not investment real estate. As a rule, investment real estate is real estate that you get rental income from, real estate that you run a business from. The only exception to that really is bare land. Bare land is considered to be investment because it's considered to be held for appreciation purposes. But land truly is the only thing you could hold for appreciation to qualify. Everything else, if you're not getting rental income from it or you're not running a business from it, it does not qualify.
Question.
Yes?
Development. You get that house, bulldoze it, build a fourplex.
Right.
Rent it out for a year.
Joe, what would you say about that? How long would you say somebody would need to rent out a property for it to qualify?
You mean a property that they
just built it and they've put a renters in there. How long would you feel comfortable that they would need to rent the property for?
Okay, that's not the, I don't think that's the question to ask. The question to ask is, how many other times has that person done this?
I think that's great, exactly.
Yeah. If they do it on a regular basis, if they build places and then sell them a year later, that's a developer.
Yeah.
If it's the first one you've ever done, I would say a year or 2 years, you're probably okay. But again, if you've done this over and over and maybe even sold a few as a developer and now you're just holding it long enough to call it rental real estate to do an exchange, I think you lose.
All right. Yes?
The question on the primary residence.
Yes.
You have run a business, a legitimate business.
We're actually going to talk about that in just a minute. Yes, thank you. So that's a good point. We'll talk about that in just a bit. Really, when it comes to 1031 exchange, there are really only 3 rules to remember. What can I buy? How long do I have? How much do I need to spend? We've already talked about the first one. What can I buy? Again, any kind of investment real estate anywhere in the country. Second question is, how long do I have? The key is this. From the day escrow closes, you need to know what you're going to buy within 45 days, though you have 180 days, about almost 6 months to close the escrow. So now again, that clock starts the day escrow closes. So when Jean sells the property for you, and you're thinking to yourself, I don't think I can find a property in 45 days. Well, one thing Jean's going to do is she's going to basically try to find a buyer for you who's going to give you a longer escrow. Okay? I've seen a lot of escrows lately for 60 days, or a 45-day escrow with an option to extend the escrow. The key is the longer you have before that escrow closes, the longer before that 45-day clock starts. But once that clock starts, there ain't no stopping it. Okay? There are no extensions, no exceptions, no excuses. You have to identify to us exactly what you're going to buy within 45 days, and you got to buy it within 6 months, 180 days. Next thing is, how much do you need to spend on the replacement property? The answer is very simple. All of it. Not just the equity, not just the profit, everything. So purchase price versus net sales price. So if I sell for $1 million, now you can, I call it the net price because you can subtract the realtor fees and escrow fees. So if you sell a property for $1 million, you pay Jean her 6%, the net sales price is $940. You need to buy equal or greater to that $940. If you buy less, you pay tax on the difference. That is referred to as boot. Boot is what you pay tax on. Part 2, equally important, all of the cash, all of the equity that comes from the sale has to go as a down payment on the new property. Any cash you touch, you pay tax on. Now, sometimes clients want to keep some cash and pay tax on it. They're welcome to do so. Just know that you're going to probably pay 30 to 35% in taxes on whatever cash you touch in California. So equal or greater. Now, obviously, what this means by default is if there's a loan that got paid off, that loan needs to be replaced. Okay, because if you sold a property, let's say the net sales price was $1 million, and you had a $400,000 loan, you have $600 of equity. All $600 has to go as a down payment on the new property, but you still got to buy $1 million worth of property. So that $400,000 of loan that got paid off, either you're going to need to get another loan, or you're going to have to dig deep in your pockets to come out with that money yourself. So equal or greater, use all the cash. And believe it or not, that's the 1031. You're selling something, you're buying something. You got to do it within a very strict amount of time. You got to reinvest everything. Otherwise, the rest of the process is fairly simple. A couple of common mistakes: not watching the clock. Please do not go on a cruise in the middle of the 45 days. They go by very, very quickly. Someone once told me they're the fastest 45 days of your life. By the way, one thing to remember also is, you could be in contract to buy your property before yours sells. I would say half my clients are already in contract to buy something by the time theirs actually closes escrow. As long as the one that you are closing escrow closes first, you're selling closes first, you can buy the replacement property the very next day. So you don't have to wait to start looking for new property. Not replacing all the debt. A lot of people, especially when they get older, they don't want to get another loan on the new property. Well, the problem is, if you don't replace the debt, you're going to have what's called mortgage boot, because you're going to buy property that's lower value. So you got to replace all that debt. Other one, getting too big of a loan. I had a client recently. She sold her property and went to go buy an apartment building in Florida. And she needed an $800,000 loan to finish the exchange. Everything was going great. And her lender says, you know what? I can get you $1 million loan, and I'll get you a better interest rate. She said, okay. And because she got too big of a loan, she had cash left over, she had to pay taxes. So you want to make sure the loan amount you have matches how much equity you have coming out of it. Also, any change of ownership, any change of how the property is titled can be a problem. Even adding a spouse. So if you own the property currently just in your name as an individual, because maybe you bought it before you got married, and now you're married, and your spouse wants to buy the new property with you, tell her no. And you have my permission to tell her no. because it needs to be the same. So if one person's selling, one person buying. If both of you are selling, both of you are buying, then that's okay. But even adding a spouse can be an issue. If you own the property in some kind of entity, like a partnership with other people, that's who has to do the exchange. Partnership sells, partnership buys. Corporation sells, corporation buys. If you want to make any changes, please call me before you sell the property, and I'll tell you whether you can do it or not. Because there are ways to do it. Sometimes it takes a little bit of seasoning, a little bit of time, but changing the vesting, any change of ownership structure is something that you have to be very careful about when doing an exchange. Yes?
What issues you will face if you add a spouse to your property, to your title?
Well, first off, if before you sell the property, you want to add your spouse to title, that's okay as long.
But not selling.
You're not selling.
I'm gonna add-
You just want to add your spouse. There's no tax ramification for adding your spouse to title. The only thing I do recommend is that you consult with your CPA as to whether or not your spouse truly has community property rights for you to add her. Because if you get married and the very next day you add her to title on the property, Joe, have you ever seen that? What's your take on that?
I say talk to your CPA, but also talk to your estate attorney, because they may have something to say. The estate attorney would be the person who set up your living trust and set up your assets within that living trust. They probably would have some advice for you regarding that. But there is no ramification for doing so, except that you are giving potentially half of the rights of your property away.
And so the key is, though, there's no transfer tax. There's no tax due to the county or to the IRS for adding or subtracting your spouse from title. I think is the main thing you want to find out. All right, now let's talk about exit strategies. This is where some of you are gonna get an idea. And Joe started to talk about this. My primary residence. As we already talked about under Section 121, your primary residence does not qualify for a 1031 exchange. However, is it possible for a property to be both an investment property and a primary residence at the same time? Yeah. A duplex. I live in a portion of the property, I rent out a portion of the property. I have a home office. If a portion of the property is deemed to be investment real estate, then that percentage of the property can qualify for the 1031 exchange. Now, how do you determine what that percentage is? The answer is call Joe, because your accountant will have to show that number on your tax return. So if you're showing 20% of your house as your home office, then you are saying 20% of my house today qualifies as investment real estate because 20% of my house, I'm running my business from it. Okay? If any of you own a farm, same thing. I got 100 acres of almonds out there, and I got my primary residence. Part of the property is my business, part of the property is my primary residence. So, and again, how that split is done is not something we help you with. That's something you and your tax advisor have to come up with on what the split is. But the key is, it is a way for you to be able to do an exchange. So using this example, if 20% of your house has been used as a home office, then 80% of the property goes to you as a primary residence. You still get your full $250,000, $500,000 exclusion against that portion. And then the 20% that of the sales price, that $200,000, you can use that to go buy a piece of investment real estate somewhere. So that's one way to look at it. The other thing you can do is move out. You bought your house years ago for $400,000. Today it's worth $2 million. Your gain is way above the $500,000 exclusion. By the way, one thing to note, that $250,000, $500,000, does anybody know when that was put into the tax code? 1997. Back then, that was a lot of money, even in San Mateo. Now, 6 months, come, you're up. So you have your gain on the property is way more than the $500,000. So what do? Move out. Turn the house into a rental property for a couple years. Now, after you've been renting out the house for a couple years, is that property now an investment property? Is it still considered to be a primary residence? Yes, because it still meets the criteria of having lived in the property 2 of the last 5 years. So the thing is, you can do this and take advantage of both tax rules at the same time. You sell it for $2 million. You pocket, assuming you're married, you pocket $500,000, and you take the remaining $1.5 million and do an exchange with it. Notice, you are not just exchanging the excess profit. You are exchanging the entire sales price minus the exemption. So if you want to speak in accountant speak, your basis has to go into the 1031. So it's not just the excess profit, it's pretty much everything other than the exemption. Now, obviously, the first question I always get asked here is, how long do you need to rent the property for it to qualify? I turn that on its head. The thing is, you got to sell the property within 3 years of moving out. Because if you move out and rent it for 3 years in 1 day, technically you have not lived in the property 2 of the last 5 years anymore and no longer qualified to. Now, at that point, the property only qualifies for 1031, but you don't get to take advantage of doing the double dipping of the 1031 and the primary residence exemption. I already just said that. Never mind. If you do it, never mind. Yeah, that's beyond 3 years. I'm not going to worry about that. Okay, how about your investment real estate? How about your investment real estate? Now you've had a property, and you're really tired of owning a rental property. What are some of the exit strategies that you could do? Obviously, you could always continue to do exchanges. One thing you could always do is just sell and pay the taxes. Government loves you when you do that. I'm not so crazy about it, neither is Joe. Seller financing is something I would recommend you look into. Seller financing basically means you act as the bank. Okay? They give you 10%, 20%, 30%, whatever you want, and now they pay you monthly. This is actually something my father did. When my father was the kind of guy, he's worked since he was 7 years old, always did his own everything, and when he was 65 years old, got into an accident, forced him to retire. After about 6 months, he goes, I kind of get used to this. I kind of like retirement. So he looked at all his rental properties and said, oh no, I'm going to get rid of them. I don't want my rental properties anymore. So he sold everything, but he sold them under seller financing. And so for the next 15 years, he got a check every month from the guy who bought the property from him. Nice thing is, there's a section of the tax code called Section 453. You only got to pay the taxes when you get the money. So he only had to pay a little bit of taxes every year for 15 years, as opposed to paying it all at once. So seller financing is something I strongly recommend you look at if you are looking just to cash out. Don't do a seller financing if you want to do an exchange. But if you're looking to cash out, it's worth looking into. Another thing that you can look at is something called triple net properties. That is where you buy a Walmart or a Walgreens or a McDonald's or a Kragen's Auto Store. Essentially, you're buying a building and you're leasing it to a company. I have seen government buildings, DMVs, post offices. I've seen university buildings. Essentially, you're leasing it to somebody, and it's called triple net, also sometimes referred to as net lease, because the tenant takes care of the taxes, the insurance, and the maintenance. So essentially, you don't have to worry about this tenant for the next 15 years because they're not calling you in the middle of the night to unplug the toilets. That's their job. There are companies out there who will also buy properties and sell it to you in fractions. It's called either tenant in common or a Delaware statutory trust. I'm not going to get too deeply into them, other than to realize that there are companies out there who said, you know what, I would love a Walmart. I can't afford a Walmart. But I can afford a little bit of a Walmart. And so what they'll do is they'll buy a property for, let's say, $40 million, get a $20 million loan on it, and come to the world and say, I need $20 million. Well, you just sold something for $2 million, you could buy 10% of it. You just sold something for $200,000, you could buy 1% of it. And it's fractional interest of commercial real estate. And the difference between that and a REIT is that here you have deeded interest in specific pieces of real estate. That's why this does qualify. And so if you're looking to cash out, again, more predictable cash flow, less management, and more importantly, you don't have to pay your taxes. I gave this talk once, and a financial planner jumped on me because I did not put in here that you can give the money away too. So a charitable remainder trust is a way to give the property to charity and get a nice big tax deduction out of it. That's another exit strategy for people. as long as the property is fully paid off. All right. One option people have always talked about is, oh, I'm just going to move into my rental. I'm going to move into my rental, live in it for 2 years, and then sell it. Does that qualify? The answer is yeah, but not as much as you think it does. Because because when the law changed in 1997, this was a common thing people would do. Move into my rental, live in it for 2 years, get my $500,000, move into my next rental, live in it for 2 years, and keep doing this until your wife leaves you. The tax code on that changed. Now, when you move into a property that was a rental property, or a second home for that matter, you have to pay taxes for the years that it was rented out before you moved in. So let's say you've had a rental for the last 8 years. You decide to move in, live in it for 2 years, and then sell it. You've owned that property 10 years. You've only lived in there 2 years. That's 20% of the time, so you only get to keep 20% of the capital gain. And so if your idea is to move into a rental property and then get your $200,000 or $250,000 or $500,000, that's not a good tax strategy. I have a better tax strategy for you. Take your crappy little rental and buy something in Hawaii. Rent it for a few years and then retire and move to Hawaii. Thank you. Exactly. Now you're basically using the 1031 as a tool to buy your retirement home. Now you're buying a property that you want to live in for many, many years, or at least until your spouse dies. Because then you get the stepped-up basis, right? But that's a better tax strategy because now you're planning to live in the property for a long, long time. Lately, I've been doing a fair amount of exchanges from the Bay Area where people are buying in like the Del Webb communities or the Sun Cities and those places where they expect in a few years they're going to retire. That's when they're going to retire to. So for now, they're renting them out. But again, ultimately, they're going to move there, live there for many, many years. Then it's a good tax strategy for them. So, all right. So this example I just gave. Another exit strategy. I did this for a woman in Palo Alto. She sold her house in Palo Alto for $1.4 million. This is a few years ago. And moved to Las Vegas. Moved the money to Las Vegas and bought 18 houses. Now you're thinking to yourself, why? Well, two reasons. One, her income tripled, better rent. But more importantly, she used it as a retirement thing. Because if she was getting close to retirement, she goes, if I need a little bit of money, I sell one house, pay a little bit of taxes. If next year I need a little bit more money, I sell another house, pay a little bit of taxes. If I just have this one property and I sell it, I can pay all the taxes. So being able to buy multiple small properties is something that is a way for you to take advantage of both. Okay, where do we go here? Questions. Can I rent out part of my home and start the clock for the 1031 exchange? Joe, you want to take this question? Because I think you and I kind of look at it slightly differently, but you're the one in charge.
Yeah. Okay, so we're talking about renting rooms, correct?
Yeah, renting out part of your house to start the clock.
Okay, all right. Yeah. Right. So let's just say I have a 4-bedroom house and I'm renting out 2 rooms. And does that start the clock? I think it does. I don't like it, but I think it does. And I think the careful planning there would be to make sure that 1, the rules don't change along the way, and 2, you're actually showing a depreciation schedule and a rental property schedule and Schedule E along the way so that you have some track record for that. There are some limitations to doing that. Generally, if you rent rooms in your house out, you cannot take a loss on that rental property. You can only go down to 0, okay? And there's a pecking order as to what deductions you take. So it probably does start the clock, but it isn't an optimal way to do to plan a 1031 exchange in the future.
Now, is it safe to say that a home office has black and white rules in the tax code, whereas renting out rooms doesn't?
I feel a whole lot better about a home office than I do about renting rooms. Yes.
I do both.
Pardon me?
I said, I do both.
Well, that's great.
What do you show in your tax return is the question.
Both. I do a complete schedule
Yeah.
of rental as well as my.
Right.
But my other question is in reference to Airbnb.
We'll get there next.
Okay.
Yes, we'll get there next. All right, so next question. What about a vacation home a second home or a vacation home, one thing to remember is a second home or vacation home does not qualify for any tax advantage. It does not qualify for your exemption because it's not a primary residence, and it does not qualify for investment real estate either because it's not rented out. Now, that said, one thing to be clear, a vacation rental does qualify. And the IRS has given us a black and white definition of vacation rental. So if you have a second home, or if you have a second home and you go, I would love to sell this thing and maybe do a 1031 exchange, the key is you need to convert it to a vacation rental. And the IRS has given us a black and white definition of a vacation rental. And that is that for 2 years before you sell it, for the full 2 years before you sell it, you got to rent it. But you only need to rent it for 2 weeks per year. That's all. Minimum 2 weeks per year. By the way, not the family. You can't rent it to your family members. But that's all. But more importantly, your personal use of the property cannot be more than 2 weeks per year.
Or your families.
Or your family, yes.
Yes.
Yeah. So thank you. So I call the 2-2-2 rule. Don't use it more than 2 weeks, rent it at least 2 weeks, and do it for 2 years. Now, at the end of that 2-year period, you can sell the property. You have seasoned the property per the IRS requirement as a vacation rental, and that now does qualify as investment real estate.
If you rent it to your family and collect rent, would that
No, no. If a full,
If you collect rent,
even if you collect rent, a full-time rental, you can rent to family as long as you're collecting market rate rent. But a vacation rental does not qualify. It's considered personal use, even if you're charging them rent. Okay. And with that, I think we are, come in. Click on the screen, what? There. Oh, I got it. Sorry. Anyway, that's it. You can stand up here also. Any questions for any of the three of us? Yes.
So let's say you inherit property, right? Your parents passed away, you inherit the property, stepped up in value.
That's what?
Stepped up
You
value.
inherit the
Yes,
property,
got-
so then it steps up in value.
Sure.
So let's say your parents bought it for $100,000, now the value is $1 million.
Yes.
Okay, so that's $1 million. I decide to keep it. I say, this is great, it's debt-free, I can get rent, get a little income. So I hold on to it for 2 years, renting it, and I want to sell it. So, and now the value is $1.2 million. So that the amount of capital gain that I'm.
Correct. And also the depreciation recapture for the depreciation you take it during that time. So basically, when you inherit property, it's just like magically you bought that property exactly as it is for that price. So it's just like you bought it for $1 million, you get a new depreciation schedule, and now it goes up, and that becomes your gain. Exactly.
Now, one more thing about that. You mentioned that you inherited it from your parents, okay? That means that when you go to the county, you get to take your parents' property tax base, okay? You don't start all over again. Whereas if you inherited it from your brother or sister, brand new tax base. So that's one reason why I recommend to clients who have actually inherited property from parents to think about keeping it. Because we had one where the property tax base was like $2,000 a year and it was a $2 million property. So I'm telling them, you're saving $18,000 a year in property tax, that you don't have to pay that others may pay in the same situation. So if you're renting it out, that's a bonus.
And so then so the 200,000.
Yes.
So then if I wanted to buy another property to avoid.
Right.
Paying capital gain, I have to buy something for 200,000.
$1.2 million.
Oh, $1 million.
Because the sales price. You're selling as a rental for $1.2 million. You got to buy $1.2 million worth of property. Just like it's a regular exchange at that point. It's like you bought it for $1 million, you're selling it for $1.2 million, or pay capital gains. One thing actually Joe mentions that I want to point out to you, and this may apply to you either because you still have parents who are still alive or because you're planning your own. If you have 2 properties and 2 kids, please don't give a half of the property to each kid. One, they don't like each other, and two, they don't want to own real estate together. And the problem is, if you do that, and I actually, from personal experience, is exactly what happened. Okay, parents died. Joe and I inherit property. We inherit half of property A and half of property B. We decide that
Just
hell
to
with
make
this.
it fair?
Yes.
Right.
Okay. Yes. And just be fair, because we want to be equal. My parents loved us,
Right,
loved us
yeah.
both, right? But we don't want to own half of a property. We want to own a property. So what do? We swapped our interest. You get all of property A, I get all of property B. But the problem is when you do that, the whole property tax basis, back to the top.
To the half.
To the half, because exchanging between siblings does not allow for that transfer of property tax basis. So if you're looking, if this is something to work on with your own estate plan, where especially if you know your kids are if they're going to sell everything anyway, who cares? But if you're going to keep it, make sure the one who's going to keep it gets to inherit it, so that they can get that property tax basis.
One more thing about 1031 exchanges. If you're going to do a 1031 exchange and you're selling your property, or you're buying your target property, don't buy it from somebody who's a related party. Because if they do, they have to also do an exchange into something else. So it starts this whole thing. So generally, don't do that.
Yeah, anything you do with family, as far as exchanges go, call me first.
Yeah.
Yeah.
Sometimes
it's okay.
Or just don't do
Sometimes
it.
it's hell no.
Just don't do it.
Yeah, exactly. Yes.
So you talked about children inheriting the basis.
Right.
Right.
Is that for primary residence?
Everything.
Or everything?
Everything. Your stock portfolio, your art collection, everything. Any other questions? Just to let, for people out there, what I handed out, I think one per table, so hopefully if you're a couple of, I have a couple of extras. This is basically the rules of 1031 exchanges. Summarize what's in there. Most of it is in the slides that Jean gave you as part of the handout, but this gives you something that you can refer back to as well. And yes, my information is on there. But if you have more questions, feel free to call us. Jean, you want to say anything else before? It sounds like they're done with questions.
Any other questions, though?
We'll all be hanging around here afterwards.
Yeah.
And so, to step up.
Yes.
When you step up the property value, does it trigger the property taxes?
Depends. If it's parent to child,
Yes.
child to parent, no, it does not trigger. So you might have that $200,000 property tax base. The property is now worth $2 million. You get a $2 million step up to the $2 million, but you still get to keep the $200,000 property tax base if it's parent to child or child to parent.
And one thing to note is you also have to go down to the county assessor's office and fill out the Proposition 58 paperwork to be able to get that. It's not automatic.
Yes. Yes, not automatic at all.
Proposition 58 is the parent-to-child transfer.
Yeah.
And by the way, if the interceding parents are deceased, it can go from grandparent to grandchild. But the interceding parents must be deceased, not dead to you. Not
Right. Another one, though, is if the mom dies and the daughter inherits, okay, from the grandparents, if her husband, the father, is still alive, then it doesn't work.
Unless he remarries.
Unless the father's married.
Yeah, unless he remarries.
Yeah, it's really quirky. I don't understand
exactly.
why. It's not even the one that's related to the person who inherited from.
Right.
It's, yeah.
Can you repeat the spouse issue? If the spouse dies, what happens?
On which one? We're talking about a lot of dying spouses.
Property.
The step-up basis with community property. With community property, stepped-up basis.
Yeah, okay, so if the property is community property, it's either noted as community property on the title, or it's in a living trust, which assumes, community property with right to survivor. Then the remaining spouse, the surviving spouse, gets all of the property at the stepped-up basis. So they could sell the next day and there's no problem. No gain.
And the alternate here is, and the reason it seems a bit strange to you is most of us, especially if you bought your property 20 years ago or more, you probably bought it as joint tenants. And if you own the property as joint tenants with your spouse, or you have an old trust that's called an AB trust, then the death of one spouse only gives half of the step up to the surviving spouse, whereas community property gives the full step up in basis, your half and the other half. So yeah. And there's usually not a good reason to be joint tenants with your spouse. You be joint tenants with like a child or somebody else that's going to inherit the property. But with spouses, you're much better off being community property with right of survivorship, because that gives the benefit of community property and the automatic transfer of joint tenancy.
Right, so, go ahead. I'm sorry, I was going to say one more thing about that. So if you have a property and you have 3 joint tenants, and you think that when you die, someone else is going to get your 1/3, it doesn't work like that. If you're joint tenants, the remaining tenants now own the property. So if you want to do it to where each person is able to say who their heirs are, that would be tenants in common, not joint tenants.
And by the way, let me add one thing about this. This is also why, and I'm going to make a couple of you mad right now, I know this. This is also why you never add your children to title on your property. Because when you add the child to title on your property, I know a woman who did this. She added her 3 sons to title as joint tenants, and when she got hit by a bus 3 months later, sadly, a true story, her kids only got a quarter stepped up basis. As opposed to if she had the money for a trust with her 3 kids as the beneficiaries, they would have gotten the full step up in basis, and there would have been no tax consequence. So adding your children to title, the way our tax code is designed in this country is very different from other countries, because I know that's a lot of it. But the way our tax code is designed, it's much better to inherit property than it is to have it gifted to you. And when you add your kids to title on the property, you're actually giving them a gift.
That's right.
Because you're giving them half your property. And by the way, if you don't see a good CPA and the IRS sees that you did that, you could be hit with a gift tax. So adding kids to title is usually a very bad idea. Please talk to your CPA and a good estate attorney before you do it.
If somebody gifted his house to his family member, would that change?
You're basically giving them your tax basis. You're giving them your current capital gains tax basis. So all the profit that you have, by giving it to them, you're giving them that profit.
They step into your shoes. All the rights that you had and all the taxes that you potentially owed, they now owe. So if you gift something before you die as part of your plan for whatever reason, instead of allowing that person to inherit it at your death, then that's not good, because they will not get the step up in basis. Let me tell you a situation I had. So I had an older gentleman. He was in his 80s, and he needed to go into a rest home. He has 2 daughters, and he bought his property for like $100,000. The property was worth about $1.8 million. So the daughter, who's my client, she called and told me about this, and she said, well, we need to sell this property, short of getting like a reverse mortgage. We need to sell this property because my dad, his parents lived well into their 90s, so he's going to need a lot of money for care. So I said, okay, how much is his care per month? And she said, it's about $6,000. I said, how much can you rent his property out for? Okay, and she said, probably $3,500. I said, so you're $2,500 short. So here's what you do. You take the $3,500 in rent, you and your sister make up the other $1,250 to pay his $6,000 bill. You don't sell the property. When he dies, you inherit it with the step up in basis, and you pay no capital gains. Because if you sell it now and you have a $1.4, $1.6 million gain minus his $250, you're going to end up paying $400,000 to $500,000 in tax. So for the inconvenience of having to come out of pocket $1,250 a month for the next how many years your dad lives, I think it's worth it. And that's not only that, but the appreciation between now and the time he actually dies. You get a step up on that too. And so that's what they did.
Yes.
Can you do a reverse mortgage then on his property? So in case you can't come up with that.
No, you can't, because reverse mortgages, they will not give you a reverse mortgage on a property you rent out.
Right. You have to live there to do it. And even if you have one and you move out within 6 months, they want the money.
Yeah. They know what's up.
Exactly. You have a question back there?
I do. So going back to that example of never leaving one property, if you have 2 properties, give one to each child. But let's say somebody did leave one property to 2 children, and one of them bought the other one out. how,
So they would get to keep half of the property tax basis that they inherit from the parent, and the other half, because they got it from the sibling, would be a full market value. So they would have a blend of the property tax.
Right.
They don't get the full benefit.
and
But-
that is triggered by equity, that would be fine.
Sure.
Right.
The sale, yeah, any kind of sale. And obviously, the child who sells it to the other one will not have capital gain, because assuming he'll have step up in basis, and shortly thereafter, within a few months or whatever, he'll sell it, the half to his brother. He won't have any gain. He'll walk away scot-free. The brother will have the rest of the house with the half and half kind of a basis for assessment.
Right, but that's also assuming he sells it within, or shortly after
Yeah.
inheriting the property, so there is no gain.
Yeah, so I'm saying, so shortly, yeah, right.
Okay. Any other questions you guys have for us today? Again, we'll be around if you have more, but otherwise.
Gene, thank you so
please.
much.